Hi, welcome to Ventura.
In the next few minutes, we're going to tell you what a bear put spread is and where you should try and employ it. Then we'll tell you what it exactly entails and what you can expect to gain or lose if the stock moves as per or against your expectations. And finally, we'll run you through a practical numerical example to illustrate the concept, followed by a review of the concept. As the name suggests, it's a bear market strategy, which basically means you expect the markets to go down marginally. It involves purchasing and selling of puts. And since it involves both purchasing and selling of put options, you're creating a spread. Now, when should you employ a bear put spread? The most essential condition, as you may have figured out by now, is that you expect the market to go down a little. You must be marginally bearish about the market. Another equally important criteria is that you expect the market not to move much until your calls expire. Here's what you need to do to make a bear put spread. You purchase a put option on a particular stock at a relatively high strike price, and you simultaneously sell a put option with a lower strike price on the same underlying stock with the same expiration date. Now, why would someone go in for a bear put spread? For one, you reduce your payout as you recover some of the premium you pay for the long put from the sale of a put of a lower strike price. Second, you do expect the market to go down marginally, but you would like to limit your loss if it doesn't. Overall, you limit your potential losses at the cost of limiting your profit if your view is correct. Now, what's your potential payoff? As we've explained before, both your risk and return in a bear put spread are limited. The risk is limited to the net premium that you pay. You face the risk the price on maturity may somehow rise to or above the higher strike price. The maximum reward is the difference between the strike prices less the premium you pay. It will accrue when the maturity price is at or below the lower strike price and both options lapse. Let's look at an example to make this strategy really clear. Let's suppose the Nifty current month future is at 6,200 and you feel it will close at 6,000 at maturity. You could set up a bear put spread by buying one lot at a strike price of 6,200 and simultaneously selling one lot at a lower strike price of 6,000. This strategy will cost you 50 rupees, which is the net premium that you pay. Here's what your payoff at different maturity prices will look like. Below the lower strike price, you make the maximum gain, equal to the difference between the two strike prices less the net premium that you've paid. Above the higher strike price, you make the maximum loss, which is equal to the net premium that you have paid. And between the two strike prices, your payoff keeps falling as the price rises. As you can see from the payoff table, at 6150 is your break-even point. Once Nifty goes above 6150, you start making a loss up to 6,200. Once Nifty goes above 6,200, your loss remains stagnant, which is equal to the net premium that you have paid. Now let's look at what happens if the market goes below 6150. Below 6150, you start making a profit up to 6,000. If the market goes beyond 6,000, your profit remains constant at 150. Now let's summarize our example. The cost of spread is 50 rupees, which is the net premium paid. The spread range is the higher strike minus the lower strike, which is 6,200 minus 6,000, which is 200. The maximum loss is 50 rupees, which is the cost of the spread. The maximum profit is 150 rupees, which is the spread range minus the cost of the spread. Your break-even point is 6150, which is nothing but the highest strike minus the cost of the spread. I'm sure you're clear about the reason for structuring a bear put spread by now, which is basically the expectation that the stock or the index will fall marginally. Remember that it's time to exit the strategy when the market crosses the strike price of the put that you have sold and it seems likely to rise again before maturity. To quickly recap, a bear put spread is a bearish strategy. It can be applied to a market, index, or stock that is expected to fall marginally. It limits your risk but limits your return potential as well. So in a nutshell, it is a strategy for traders with a low risk profile. Thank you.